Today in this video, I'm going to give you a few reasons why you shouldn't invest in HCAL and what's alternative if you want to invest in banking sector for passive income. If it's the first time on this channel, this is Mr. Money channel. On this channel, I talk about this type of cover called ETFs and ETFs in general and other individual stocks sometimes. So just make sure you subscribe because I always bring updates and news on most ETFs, whatever the news come from, either in Canadian market or US market. So let's look at HCAL. What's an HCAL? I've talked, by the way, I've talked about this ETF before. And if you wanna look the video that I made comparing this and other ETFs, you can check on the link below. So highlight top performing Canadian bank ETF with plus 18% annualized total return. HCAL outperformed the average of the big six bank with a similar volatility. Yield is 7%. A good fit for investor who wants to equate exposure to Canadian big six banks with modest 25% cash leverage, enhance the growth potential, and highest monthly income. And it does pay monthly distribution, so you get the monthly dividend and it's perfect for passive income. So look at the fund objective is HCAL is designed to track 1.25% the return of Solactive equal weight Canadian bank index, invest in Canadian banks using modest 25% cash leverage. HCAL does not use a derivative, so use actually cash. So we look at the this is of course ticker symbol is HCAL. Yield right now is 7%. We look at annualized year to date is about 5%, and its inception has returned pretty well, about 18%. We look at the what they invest in. First of all, let's look at this here. We look at the exchange, of course, is in Toronto, and index pays 25% selective. That's the index it follows, and distribution is monthly. MER is 65.65. That's management fees, right? Risk rating is medium to high. We'll look at what does it invest in. Okay, the holding of this 100% invests in HEB, Hamilton Canadian Bank Equal Weight Index ETF. This is a brand new ETF that came on the market. And then the banks that they invested, because it's equal weight right now, we look at the Bank of Nova Scotia, National Bank of Canada, Royal Bank of Canada, Bank of Montreal, Canadian Imperial Bank of Commerce, which is CIBC, and Toronto Dominion Bank. They are all equal weighted. You can see here, Bank of Nova Scotia is about a little bit 17%, because of course as a little bit maybe outweigh because it has performed well and it just went up about little just less than 1%. But you look at the numbers, they're pretty equally weighted. Look at the HEB, that's what invest in. We'll look at this is HEB itself. This is a brand new ETF, just came in the market or come to the market. Look at this one, it's lowest. By the way, if you want to know more about this one, also I made a video on this when it came out. It does pay only 5%. That's a distribution right now it pays. But if you look at the management fee, it's only 0.19, very low, right? Compared to 0.65. So 0.65 plus all the fees, that one, because it's active, HCAL would have been almost close to 1% versus this one, HEB, look at this, in 19. So here the reason why you should invest. I mean, here the reason why you might as well just stay away from this one. I mean, if you want, you can. It has a really great return if you look at 18%. But here's the thing, that it pays 7%. Why you shouldn't invest in this? First of all, it does use leverage, and that means it's more riskier than HEB, which just came. This is actual index. It does not use any cover call strategy, anything like that. It's just a straight index. It follows the index. And HEB is a 5 right now, is 514, but this is less riskier because HCAL invests in HEB, so may as well just invest in HEB, right, itself. And if you look at the yield, yeah, this one pays 7%, and HEB, pays. We look at here, it only pays 5%. you know, and monthly, by the way, 5%. That's it. But if you look at the fees, these fees are very low, that you paying here versus what you're gonna pay on HCAL. You pay a little bit more. So the 1% advantage of that you have, 1.5% you get on that, it's just gonna be eaten by the fee that you're gonna pay on this one. So that's one of the reason. And second reason, so why invest in a HCAL? Why you can just invest in a HMAX, which pays a little bit higher yield, about 14%, and also it doesn't invest all the money, only invest the 50% of the position, and then let 50% for growth. So if you really want to generate a high yield, avoid HCAL and just buy HMAX. That's what I can say, because I don't see any point of that. Look at this. When it comes to fees, it does pay. You got the fee is 65, so it's pretty much the same. And medium, the risk rating is medium, and it pays monthly, right? So, and then those are the company invested in. But this is market cap weighted. So the biggest, it takes the bigger position, right? That's what it is. So Royal Bank is the biggest bank in Canada. It takes the bigger position, and Toronto Dominion Bank, Bank of Montreal. So there it goes like that. That's all what I can tell you today. I just wanna, make the point that HCAL, I believe, is just absolute. Doesn't really, I know these managers, they're very smart people than me, but I think, why would you invest in HCAL? You get 7% and you get the same risk. Yeah, you can just run HMAX. So I would say, instead of investing in that, just invest in HMAX. Or if you wanna even a more safer one, you can invest in HEB, which is Hamilton Canadian Bank Equal Weighted Index ETF. So, and if you wanna also look at the difference I made between HCAL, HFIN, this one, and HMAX, I also made a video on that. So this is a series. This is a part one. I'm going to talk about part two, which will be HFIN. So thank you for watching this video, and if you have any comment, just make sure you leave your comment below. And if it is your first time, just make sure you subscribe on my channel, so we can grow and we can spread the information on this passive income vehicle, so we can all achieve the financial freedom. Bye bye.